Welcome to Iron Financial. This is the explainer where we help you forge a stronger portfolio and cut straight through the market weakness using hard, undeniable data. I'm your lead analyst, and today we are executing a ruthless, totally no-nonsense teardown of Microsoft's fiscal year 2026 Q4 earnings report. We're literally pulling up the floorboards, we're inspecting the structural integrity of their massive balance sheet, and we are going to separate the raw iron from the accounting fluff. If you're serious about building a portfolio that can withstand this kind of market volatility, hit that subscribe button right now.
And I'm the market skeptic. Look, I'm here to ask the exact questions you are all thinking at home. We have all seen the flashing headlines, we've seen the massive top-line numbers, but I want to know what is actually holding this entire structure up. Is this just peak AI hype, or are we looking at real cash-generating operational iron? Let's get to work and find out.
So here's the core tension we're dealing with today, folks. Microsoft is basically betting the entire company on artificial intelligence infrastructure. But is this massive structural pivot generating real durable cash? Or are we looking at a hyperinflated valuation that's built on a foundation of unprecedented, totally unsustainable capital expenditures? We need to know if this stock is forging a brand new era of enterprise computing, or if it's slowly melting down under the weight of its own AI capex furnace.
That is exactly the right framework to use. Look, you just don't build a massive skyscraper without pouring a huge concrete foundation first. Today, we're going to look at exactly how much that foundation is costing them, and honestly, more importantly, what kind of rent they are already collecting on the floors they have built so far.
All right, moving to Section 1, Forging the Foundation. We're breaking down the $90 billion top line. Let's start by tearing down the exterior of this Q4 report to really inspect the load-bearing pillars. You absolutely cannot evaluate a company of this scale without first wrapping your head around the sheer volume of capital flowing through its doors every single quarter. We need to look at the headline numbers, but then aggressively strip away the currency fluctuations so we can see the organic, raw strength of the business. Boom. Look at this load-bearing pillar right here. $90.0 billion in Q4 revenue alone. That is an 18% year-over-year growth on a GAAP basis. Now, if we strip out the foreign exchange noise, it's still a 17% growth in constant currency. What that means is, even when we remove the favorable exchange rates of the US dollar, the underlying global demand for their products is still absolutely soaring. For a company of this immense size to grow at nearly 20%, it's literally like watching an aircraft carrier maneuver like a speedboat. It's staggering. And if we zoom out to the full fiscal year 2026, we are looking at $331.8 billion in total revenue, which is up 18%. The top line structural integrity here is, quite frankly, phenomenal. And the beautiful thing for investors is that this incredible top line translates straight to the bottom line. Q4 GAAP net income hit $35.8 billion. That is a blistering 31% year-over-year growth. Full-year operating income reached $155.2 billion, up 21%. I really want you to pay close attention to the math here because this is crucial. When your net income, which grew 31%, is growing significantly faster than your top-line revenue, which grew 18%, it means you are forging serious margin expansion. Margin expansion is basically the holy grail of Wall Street. It means you aren't just selling more stuff, you are wringing significantly more pure cash out of every single dollar that comes through the door. Costs are being controlled while prices or volumes go up. This is exactly what a remarkably solid structural foundation looks like. Okay, hold on, lead analyst. Let me step in here and point a flashlight at the drywall because I think I'm seeing some accounting spackle covering up some cracks. The financial headlines out there are screaming about a $4.81 GAAP earnings per share, which sounds amazing because it's up 32%. But when we look at the non-GAAP EPS, the adjusted operational number, it's actually $4.74, and that's up only 23%. So I have to ask, why is there a massive 9% gap between the headlines and the adjusted reality? A 32% growth versus a 23% growth is a huge discrepancy when you were talking about billions of dollars in market cap. What exactly is driving this gap? Why are the adjusted earnings lower than the reported earnings? We really need to separate the day-to-day operating reality from the balance sheet magic.
Let's pull off the plaster right now.
Management actually admitted there was a 27-cent discrete EPS benefit in this quarter that was nowhere in their previous guidance. And spoiler alert, this wasn't because they sold a record amount of new software out of nowhere. A massive chunk of this is a $3.2 billion non-operating gain from their investment in Anthropic. Let's be crystal clear on what that means for everyone watching. That $3.2 billion gain from Anthropic, that's just a paper markup on an investment. It's not real cash generated from daily operations. Sure, it makes the earnings per share look absolutely incredible on the front page of the financial papers, but it doesn't pay for the cooling systems in the data center. They also had lower than expected costs from a voluntary retirement program, which conveniently offset some really heavy severance and impairment charges over in the Xbox division. On top of that, their OpenAI investments added $480 million, or 7 cents per share, to Q4 net income alone, and nearly $5 billion to the full fiscal year. So my question is, how much of this $35.8 billion net income is a well-oiled operating machine, and how much is just paper gains on AI startups?
It's a very fair pushback, skeptic. The Anthropic gain is indeed a paper markup, no doubt about it. But listen, even if you entirely strip out the OpenAI impact and focus strictly on the non-GAAP net income, it still grew 22% to $35.3 billion. The core business is still a cash-generating monster, even when you scrape off all that accounting spackle.
Okay, moving to Section 2, Azure's $100 billion pillar. This is the cloud and AI engine. Let's pivot away from the accounting nuances for a second and move straight to the strongest structural component of the entire business. We need to evaluate the core cloud and AI engine because, frankly, this is the furnace powering the entire Microsoft factory right now. If this pillar cracks, the whole building comes down. And right now, it is absolutely not cracking. Azure and other cloud services revenue accelerated to a massive 43% year-over-year growth. Wall Street was expecting 40%, and Microsoft just blew right past it. This is the real signal in the noise. I really want to emphasize the law of large numbers here. Growing at 43% when you are a tiny little tech startup is one thing. Growing at 43% when your revenue is already tens of billions of dollars is practically defying financial physics. Overall, Microsoft Cloud revenue jumped 27% to $59.3 billion in Q4 alone. This completely proves that enterprise demand for AI infrastructure isn't just in some cute pilot program phase anymore. It is full-scale, structural deployment. Just let this sink in for a second. Azure crossed the $100 billion annual revenue milestone for the first time this year. We are looking at unprecedented scale for a single product line. It is forging undeniable momentum. The AI cash machine is fully 100% operational. They are not just selling the picks and shovels for the AI gold rush. They own the mine, they own the refinery, and they own the railroad that ships it all out. If you're an investor looking for a competitive moat, this is exactly what a mile-wide, impenetrable concrete moat looks like. But hey, if you want to know what the future looks like, you don't look at the past quarter, you look at the backlog. The commercial remaining performance obligation, which, for those who don't know, is the revenue they have securely contracted, but just haven't formally recognized on the books yet, surged an unbelievable 84% year-over-year to $678 billion. This $678 billion backlog is the ultimate safety net. It represents highly predictable, locked-in future cash flow that completely shields the company from short-term market panics.
But wait a minute, earlier this year, almost half of their AI growth was tied directly to OpenAI. So is this $678 billion backlog just a giant circular transaction with one major partner?
Actually, the data says no. The sequential growth in this quarter's backlog came largely from customers other than the big core AI research labs. This is absolutely critical for portfolio stability. It means the demand is finally broadening out into the wider enterprise market. It's not just OpenAI underwriting the whole story anymore. And here is the concrete proof of that enterprise integration. Microsoft 365 Copilot has officially exceeded 30 million paid seats. That is up from 20 million just a short time ago. This isn't just tech companies running high-level AI experiments on Azure. This is 30 million everyday individual workers having an AI assistant bolted directly into their daily Word, Excel, and Teams workflows. And remember the pricing power here. These are paid seats, often costing companies an extra $30 a month per user. That is incredibly sticky, high-margin recurring revenue that heavily reinforces the structural foundation of the stock. Once a company integrates this, they almost never turn it off. Okay, I hear the bull case, lead analyst, but let's look closely at the stress fractures. The demand is clearly there, obviously, but can they actually fulfill it? We know for a fact that Microsoft is facing a severe compute crunch right now. They are literally rationing AI chips between their Azure Enterprise customers, their own internal research and development, and powering those 30 million Copilot users we just talked about. If they're throttling capacity like that, they are leaving massive amounts of money on the table. So is this 43% growth actually being suppressed by their own supply chain bottlenecks?
Look, it's definitely a high-class problem to have more demand than supply, but you're absolutely right to point it out. If they can't get the specialized cooling, the networking gear, and the semiconductor components fast enough, that $680 billion backlog might take much, much longer to convert to realize cash than the market actually wants.
All right, moving to section 3, cracks in the armor. We've got to talk about this legacy hardware weight. Since we're looking at stress fractures, it's time to transition to the dark side of this earnings report. I want to inspect the structural rot and the crumbling drywall within the legacy segments of the company. Because while the cloud is flying high, the hardware divisions look like they're bolted to the floor. Satya Nadella, the CEO, came out and said, "We are advancing the frontier on the cost-to-outcome curve, ensuring every customer can turn tokens into business results." Look, it sounds incredibly visionary in a press release, but while they are busy turning digital tokens into business results up in the cloud, their physical hardware down here on Earth is rapidly turning into deadweight. Let's look at the segments that are completely failing to deliver. Market skeptic. I am pulling back the curtain right now on the more personal computing segment. Revenue here dropped 4% to $12.9 billion and was down 5% in constant currency. Windows OEM and devices, down 7%. The broader PC market is supposedly in a recovery phase, but Microsoft's hardware sales are undeniably weak. And then there's Xbox. Oh boy. Xbox content and services revenue dropped 10%. Digging deep into the SEC filings, Xbox hardware revenue plunged a staggering 29% due to lower console volumes. Think about that capital allocation for a second. You don't spend $75.4 billion acquiring Activision Blizzard just to watch console volumes plunge 29% and then immediately start taking impairment charges. They are laying people off in this division as we speak. Is consumer hardware just structural rot dragging down the broader enterprise cloud growth? It sure looks like it. Okay, you have to weigh the segments proportionally here, skeptic. Yes, the legacy hardware is rusting. I'll give you that. The 29% drop in console volumes is undeniably ugly. But more personal computing is now a much, much smaller fraction of the overall business compared to the intelligent cloud.
Market skeptic, but it's a massive drag on operating margins.
Let's quickly clarify operating margins for our viewers. Operating margin is simply the percentage of revenue left over after paying for the variable costs of production, like wages and raw materials. It shows how efficiently a company is running its core operations.
Exactly my point. And they took heavy severance and impairment charges in Xbox this quarter, which completely destroys that efficiency. You can't just ignore a $13 billion segment that is shrinking while the rest of the company is trying to sprint. It requires management attention, it requires massive capital, and it is a highly visible crack in the armor that investors are completely ignoring right now because they're blinded by the shiny AI object.
All right, Section 4, the heavy CapEx lift. Let's evaluate these heavy machinery costs. Fair point on the margin, skeptic, but let's talk about where the real capital is flowing. We need to move to the absolute most critical part of this teardown, evaluating the heavy machinery costs required to sustain this massive, rapidly expanding AI skyscraper. Because let's be real, you do not grow Azure at 43% without spending an absolute fortune on infrastructure. Here's the number that dropped jaws across Wall Street. $35.8 billion. That is their capital expenditure for additions to property and equipment in a single quarter. It more than doubled from the $17 billion they spent in the exact same quarter last year. To put that into perspective, their entire GAAP net income for the quarter was $35.8 billion. Think about that. Every single dime of profit they made in Q4 was essentially poured straight back into concrete, liquid cooling systems and specialized AI chips. And that is exactly what terrifies me. Look at the full fiscal year. $115.9 billion in CapEx. This is a historic, unprecedented level of heavy lifting just to keep the AI furnace burning. They have another $34.6 billion already committed strictly for the construction of new data centers. My question to you, lead analyst, is this. What happens if the AI adoption curve flattens out even a little bit? If enterprise customers decide they just don't need to run massive AI workloads next year, Microsoft is going to be left holding a $116 billion bag of rapidly depreciating hardware. This isn't a foundation, this is a massive financial burden. That is the risk for sure, but look at the cash flow. This is exactly why we call it iron financial. You have to look at the structural capacity of the balance sheet to handle that burden. In Q4, they generated $55.4 billion in operating cash flow. Yes, they spent $35.8 billion in capex, but they generated almost $20 billion more than that in pure cash from operations. Over the full FY26, they generated $182.9 billion in operating cash flow. They even returned $10.2 billion back to shareholders in Q4 via dividends and buybacks. Being able to self-fund your own growth is crucial, especially in a high interest rate environment where borrowing money is incredibly expensive. The foundation is absolutely strong enough to handle this financial weight without taking on any toxic leverage. They are self-funding literally the largest infrastructure build-out in tech history. Self-funding or not, it's a massive risk profile change for the stock. We've torn down the top line, we've inspected the cloud pillars, we've found the cracks in the consumer hardware, and we've weighed the massive capex burden. It is time to deliver our final nonsense ruling. Does Microsoft's FY26 Q4 performance justify keeping this heavy metal in your portfolio? That brings us to Section 5, the verdict. Opportunity or trap?
Let's synthesize all this data and take our time reading down this ledger. On the iron side of the balance sheet, we have a $678 billion commercial backlog that's surging 84%. We have Azure re-accelerating to a staggering 43% growth, completely defying the law of large numbers. And we have $182.9 billion in full-year operating cash flow, proving they can finance this massive growth entirely internally.
But on the fluff side of the ledger, we have $3.2 billion in paper gains from Anthropic that's artificially boosting the EPS on the front page headlines. We have a consumer hardware division with Xbox revenue down 10% and console volumes crashing 29%, showing very clear structural rot. And we have a $116 billion annual capex beast that demands constant feeding, leaving absolutely zero room for execution error on the AI demand side.
So I pose the ultimate question to you, the viewer. Looking at this teardown, is Microsoft the solid, load-bearing foundation your portfolio needs? Or, at these valuation multiples, are they just an overextended capital spender, walking a very thin tightrope into fiscal year 27? Because let me tell you, if that AI backlog doesn't convert to cash fast enough, that $116 billion in concrete and chips is going to get very, very heavy. Here is my final verdict. The cracks in the personal computing armor are real, and the accounting gains require a highly skeptical eye. But the sheer velocity of Azure's growth, backed by an exploding $678 billion backlog, proves the core AI thesis is totally intact and generating real structural demand. As long as operating cash flow outpaces the capex build-out, the structural integrity of this company remains absolutely unparalleled. It is a long-term opportunity, provided you have the stomach for the heavy capex cycle. But we want to hear your verdict. Is this raw iron or is it a trap? Let us know in the comments below. And if you want to keep forging a stronger portfolio through the noise, don't forget to subscribe to Iron Financial. We'll see you on the next teardown.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.